Now, let's say the Commerce Commission did something which meant that the bank's profits would shrink away. That won't matter at all with regard to the interest rates you pay, because the interest rates you pay for your borrowing are set by what the Reserve Bank thinks is necessary in order to drive inflation up, or in this case, drive inflation down. Well, hello again, everybody, and welcome to another Tea with Tony, or at least a monthly look at what's happening at the economy, in the economy, from myself, Tony Alexander, sponsored by NZHL. Now, for this month, I've been asked to have a look at what's been the latest developments for the New Zealand housing market, also interest rates, have a look in particular at the economy with regard to household consumption, the spending that you and I do, and if I've got any time available at the end, just give a wee thought on the Commerce Commission's investigation into the New Zealand banking sector, and maybe some thoughts also with regard to the election, which of course now is less than 4 months away. I think it's creeping up relatively quickly. So let's start out by having a look at what the latest data tell us about the state of the residential real estate market around New Zealand. Basically, we can see when we adjust for seasonal factors, what usually happens in March, April, May, etc., that sales are improving. They've gone up almost 19% in the 3 months to May as compared with the 3 months to February. So turnover is improving. Prices on average are not yet rising, but basically they have stopped falling. Over the past couple of months, the seasonally adjusted monthly change in prices has essentially been zero. So I think we can say that the housing market has bottomed out. And of course, the question becomes, where do we go to from here? Now, with regard to what's happening with interest rates, over the past month since I last spoke, we've seen some small increases in bank funding costs for when they lend out to you and I for 1, 3, 5-year fixed interest rates, only by about 0.1 to 0.15%. Now, these increases haven't come about because of any great change in expectations for monetary policy in New Zealand. Instead, they largely reflect what's happening overseas with regard to monthly job numbers coming in a heck of a lot stronger than people had been expecting, especially in Australia, the United Kingdom, and in the United States. That's led the central bankers over there to warn that they're going to have to tighten monetary policy further. Financial markets are factoring in at least 2 more rate rises, certainly in the UK and across in America. In Australia is a little bit more interesting because just the other day we got an inflation number out which came in 0.5% lower than the market had been expecting. It's still high at 5.6%, so it's not as if the Reserve Bank of Australia is going to suddenly become relaxed. And there is a particular dynamic in Australia where the unions tended to be larger, stronger than in New Zealand, and many of them are going explicitly for compensatory wage increases of the inflation rate plus a little bit more. Now that of course is a thing that central banks get worried about. You have a first round of price rises, inflation. Their focus is on what happens once you get consumer prices rising a certain amount. They're concerned that it leads into a bit of a wage price spiral out there. So that ball is still rolling in Australia, and it means that their interest rates are probably still going to go higher. So those have been the main developments in terms of what's happening in the residential real estate market and with the wholesale interest rates. Just briefly for retail interest rates, the mortgage rates in New Zealand, banks have been doing a little bit of a catch up with the cost to them of borrowing, rising quite a bit actually over the past 2 to 3 months. And we've seen a round of increases in the 1 to 5 year or at least 3-4 year fixed mortgage rates out there. This time, probably, hopefully, most of us are right when we say that interest rates have now hit their peaks. Obviously, the big mistake there was ahead of October 18 last year when we got the inflation number, which came in a heck of a lot more than we were expecting in New Zealand. Most of us are now, I guess, hoping that we're going to start to get a few positive surprises down the track. Now, in terms of what's happening in the housing market, it's not just the official data we can look at from the REINZ. We can also look at what my monthly surveys are showing. I've got about 5 of these up and running. And what we can see from those is, number one, that landlords are finding it increasingly easy to get good tenants, and I think the migration boom is definitely playing a role there. There's simply more people around looking for somewhere to live. We've also got an increase in the proportion of existing landlords saying they are looking to sell. They've got debt, the interest rates are high, they're losing the interest expense deductibility, and so more of them are looking to sell. And maybe that means that once we do get turnover rising a bit more and house prices rising, some of these investors will step forward and look to basically rationalise their portfolios. At the same time, I think we do have a few more people who are not already investors looking at investing in the residential property sector. So these are people who come in knowing exactly what the tax rules are. They can run their numbers, they can do their long-term projections. So I think there just is a little bit of a difference starting to appear there between the buying and selling intentions of those who've already bought and might have been in the market for a while, and those who have not yet become property investors. We can also see from my surveys that credit is flowing more easily. We've obviously had the changes for the LVR there, the easing up on the Credit Contracts, Consumer Finance Act, and also banks just getting a bit more used to those systems in place there, and credit is flowing a little bit more freely. But of course, I also get very strong feedback in the surveys that the problem for many borrowers, they would like to borrow. Many people have good deposits, but with the bank test interest rates at 9.5%, a lot of people simply don't qualify for any extra debt at the moment, or for taking out a mortgage. Now, what I want to spend a few minutes on is my latest monthly survey of the real estate agents. So not the mortgage advisors, property investors, businesses, consumers, etc. And I'm going to run through a few numbers here. I'll just be looking down now and then to access to, I guess, reinforce the fact that A, we've bottomed out, and B, that the upside in the market, I think, is likely to be stronger than many people are thinking. There's a view out there of, the market's bottoming out, but it's not as if it's going to go anywhere interesting in the next 3 years. I disagree. I think that we have quite a number of frustrated buyers out there, people who've been sitting on the sidelines for 2.5 years, and at some stage these people are going to get activated and move back into the market. And so what I just want to do is highlight the results of my latest survey of real estate agents. These haven't been made public yet. I'm not sure if they will or will not by the time you get to see these videos, but this video. But here's just a few numbers to keep in mind. Are people showing up at open homes? Are they physically out there taking time out of their weekends to go and visit properties? Yes, we've got a net 41% of agents saying they're seeing more people attending open homes. Now, 2 months ago, at the end of April, that was only a net 3% of agents saying they were seeing more people at open homes. So yes, people are out there and they're kicking the tires. They're seeing what is on offer. Are they actually going to the auctions to make a bid? Well, yes, it seems so. A net 18% of agents are saying there are more people now showing up in the auction rooms. 2 months ago, that was minus 18%, a net 18% of agents saying, fewer people in the auction rooms. So the open home presence has sort of been rising for 4 to 5 months. The auction one has just turned around. It's like people have been having a look for 2 to 3 months and now are looking to actually make a purchase out there. Agents overall still see prices as falling, but that's only a net 7% of them say prices are still going down. 2 months ago, that was a net 58%. So this is one of the numbers I wanted to highlight. That pricing dynamic is turning relatively quickly out there. FOMO, I guess my favourite of all measures, that has been sitting at very low levels between 4% and 9% from the start of 2022 and last month. Now, with the survey I've just run less than a week ago, I've got 19% of agents saying that they can see buyers becoming concerned that if they don't pull finger, they are going to miss out. Fear of missing out. So FOMO is starting to reappear. It's still below average. It's well away from the levels of the frenzy in the second half of 2020 through to middle or so of 2021, but it is on an upward track. What's on a downward track is FOOP. FOOP, fear of overpaying. Now, people overall are still worried that they'll buy and then prices will go down. So I've got 40% of agents saying they can still see buyers having that worry. Well, 2 months ago, that was 68%. So little bit by little bit, people are becoming less worried that they'll make a purchase and then prices will go lower. Are we actually still in a buyer's market? Nationwide, the answer is yes. I've got about a net 9% of agents saying the market is still one where the buyers have the greater negotiating power. So that's what basically being in a buyer's market means. But 2 months ago, that was a net 30% of agents saying that we were in a buyer's market. So it's on the cusp of disappearing. In Auckland, it already has. Auckland is already in a seller's market. I've got about a net 7 or 8% of agents in Auckland saying actually the sellers are now starting to have the stronger negotiating position out there. So things are turning around, and that sort of feeds into the view I may have expressed here, and I've certainly been putting across in my writings in recent months, that when this cycle, the housing cycle, turns upward, I expect Auckland to outperform this time around. It's relatively lowly priced by long-term trends versus the rest of the country. And especially with the migration boom, migrants tend to go to the largest city in the country, and that is Auckland. And so that population growth in Auckland is likely to outperform again now with the migration boom underway. Oh, and just one final point there. There's a lot of listings around at the moment. At the end of May, the number of properties listed for sale, the stock there was about 25,000 or so. It's falling only slowly, but what we have now is 34% of agents saying people are just starting to get a bit concerned about deficiency of listings. That's up from 14% a couple of months ago. By historic standards, it's neither here nor there, quite frankly, but the trend is clear, just as the trend is clear in all of these indicators I've cited and a few others elsewhere. So look, the market is turning around, and I think no shortage of factors to help explain it. People are increasingly feeling that interest rates are peaking. The migration numbers are absolutely booming. The media are also discussing the way the market seems to have bottomed out. And like I say, credit is just starting to flow a little bit more freely out there in the economy. And of course, what's yet to come along is people realising that construction is falling away, and for the listings to start getting into worrying levels again. So I remain of the view, yep, the market has bottomed out, and I fall into the camp, possibly only a camp of one at this stage, of those believing that there is actually going to be a period of relatively robust growth in prices for houses in New Zealand, especially once the interest rates actually start falling. In other words, more 2024 than for 2023. With regard to household spending, I mentioned that I'd have a look at. This is important because when the Reserve Bank raises interest rates, they expect the economy to slow down. The main route by which they expect that to happen is you and I as consumers pulling back on our spending. And they've got plenty of evidence of that. We've got retail spending volumes falling 1% in the December quarter last year, 1.4% in the March quarter, probably have gone down again also in the June quarter. So the Reserve Bank are definitely seeing the restraint they want out there. And it's not just because of interest rates being at high levels, it's also that the binge is over, the pandemic binge has ended. We're devoting money to travelling overseas as well, and house prices also have come down. The labour market, I don't think, is playing all that much of a role in terms of unemployment going up and people cutting back for that reason. Actually, job numbers are continuing to rise, as I mentioned earlier, is happening overseas. But I think for the rest of this year, it's still going to be pretty hard for retailers out there, especially with still about $150 billion worth of fixed rate mortgages have yet to roll from 3.5% towards 6.5% or so. Now, in terms of, I guess, a few other things happening out there, a lot of people might be thinking, oh, this investigation by the Commerce Commission into the banking sector in New Zealand making $7 billion worth of profits annually. I think somebody calculated it was $300 per second, it might have been, for the New Zealand banking system. And maybe some people are thinking, oh, we're going to see something radical happen there and the profits are going to be falling away and interest rates are going to be lower. It really doesn't matter. The interest rates are heavily influenced by the Reserve Bank's monetary policy. Now, let's say the Commerce Commission did something which meant that the bank's profits would shrink away. That won't matter at all with regard to the interest rates you pay, because the interest rates you pay for your borrowing are set by what the Reserve Bank thinks is necessary in order to drive inflation up, or in this case, drive inflation down. And if all of a sudden the rules were somehow changed and the banks were forced to cut their interest rates by 0.5%, the Reserve Bank would be forced to raise its cash rate by 0.5% to try and get the rates back to the level they want them to be at. So frankly, it's an academic exercise. I think just keep in mind that banks in New Zealand are heavily regulated. They face a lot of costs with regard to meeting Reserve Bank regulatory requirements. The expectations, increasingly large ones, you and I have, that they stop scams. You know, you and I looking to pay money to people overseas who seem very friendly with investments we can't pass up. The costs are relatively high, so be very careful about looking at interest rate differentials there of the cost of banks in New Zealand of borrowing money versus what they lend the money at. That's decreasingly a good measure of bank profitability and where it's heading because of all these other costs out there. And finally, I was asked to talk about the election, but frankly, even the political analysts don't really know what the outcome is likely to be. The polls are fairly evenly balanced, it seems, at the moment, so let's just wait until closer to the time, and maybe when we get a few more policy announcements as well, and then maybe we can do some more solid analysis. But this far out, I think, we could basically be wasting our time to a certain degree. So on that note, let me just say that everything I've said here is my own personal view, not necessarily the view of NZHL. Definitely nothing in here is intended to be independent advice. And just keep in mind that no one around the planet has really got themselves a good record when it comes to forecasting at least interest rates since, in my estimation, about 2007. And remember, we're in a unique post-pandemic environment. None of us has lived through this before, so who knows what surprises next week will bring all of us. All the best out there.